Hello, my name is Shreyans, and today we are going to look at a company whose products we have enjoyed in our childhood. In fact, we also enjoy it as we grow up. It is one of the leading FMCG companies in India. But before we start, important disclaimer, this is not investment advice. We're just trying to understand the financial performance and position of the company so that we can decide whether we want to research further or not. All right, let's get started. The company that I'm talking about is Britannia, right? It is one of the leading FMCG companies, as you might know. But important thing to understand here is that it majorly produces eatables, right? And even within eatables, it serves a very specific, it makes very specific products like biscuits, wafers, cakes, breads, and dairy, right? There are other eatables as well. For example, the savory snacks like namkeen and chips and other things, which this company is particularly not into, nor it is into the other kind of FMCG products like related to shampoos or soaps or anything. So just eatables and mostly biscuit-like products. Biscuit is its main product, which gets its 80% of revenue. The different types of biscuits, obviously. All right. So now we'll start with the financials of the company, and then we'll wrap up with the highlights. So the interesting thing to look at here when it comes to the revenue, EBIT and PAT is that revenue is up 2.5 times, right? From 4.6, 4,600 CR to almost 11,600 CR. But EBIT has gone up to almost 9.7x from 172 CR to 1658 CR, and PAT has improved even further, right? PAT has increased by all more than tenfold from 134 CR to 1400 CR. So this is the interesting thing here. Revenue growth you could look at here is the CAGR is 10.8. I mean, so it's not bad. It's very decent. But if you look at the EBIT CAGR is 28.7% and PAT CAGR is 29.8%. So these are very, very strong growth rates, right? Especially when it comes to earnings. Okay, so now earnings seem to be pretty solid, but what about the cash flow of the company? So if you look at the cash flow and if you look at the cumulative cash flow from operations, which is greater than the cumulative PAT. In fact, the company produces more cash flow in most of the years versus the PAT. So, I mean, if you look at cash flow from that angle as well, the operating cash flow seems solid. Talking about the other two aspects of cash flow from investing. So the company has made regular reinvestments into the business, but not of very significant amounts, because we have to understand the nature of the FMCG products. The products get produced very fast, right? The turnover at time is very less. But what you notice here is that from here onwards, there have been significant outflows, investing outflows. And the reason for that is investments. The reason for high outflows is not investments into fixed assets or other operating assets, but rather into investments, which I would assume is due to the fact that company is producing excess cash that it cannot reinvest because there are not so much requirements into the business, and nor it is paying out to shareholders. So it has started investing and maintaining that cash, right? Now, talking about cash flow from financing activities, company has regularly paid the dividend for all the last 10 years. This is what I understood. It is not visible here, but if you go and look at the breakdown, you'll figure out that the company has been paying regular dividends, right? A slight positive inflow here is because of the fact that the company probably raised some slight borrowings, which you can see here in the sudden increase in non-current liabilities as well, but still it is extremely insignificant, right? I mean, compared to equity. So yeah, the most of the cash flow from financing is related to dividend payments and probably some small changes in other liabilities or other financing items. Okay, now if you think that the earnings growth was impressive, then look at the equity growth, right? The book value of equity has grown up from 326 CR to 4400 CR. It's a mammoth 13.5 times, right? And the CAGR here is 33.5, right? So the company's book value of equity has compounded by 33.5% over the last 9 years. I mean, this is a very strong position. And if you contrast the equity versus the non-current liabilities, then I mean, the company is virtually debt free, right? I mean, these in 7 out of the 10 years, it's just single digit non-current liabilities. It had some borrowings here, and then it has again raised some borrowings here. But as we talked about it, it's extremely insignificant, right? Now, before we move on to the not working capital part, let's first take a look at the non-current assets, right? So non-current assets have gone up by 5.2 times, which seems to be quite higher versus the 2.5 times increase in revenue, right? I mean, so you would expect that, the assets to grow in accordance with the revenue position or something like that. But a reason for that is that, again, in these years the company has made, significant investments into significant non-current financial investments, right? So all the increase that you see here in non-current assets, right, this all of this is not into just the fixed assets. There have been consistent increases and investments into the fixed assets, but not all of it is related to fixed assets. A lot of it also has to do with the non-current assets. In fact, to the extent that if this figure is 4100 cr somewhere, then I think up to 2000 crores of it would actually be investments, right? So that is the quantum of investments that the company has made, because it's easier to understand, right? In the initial years, the company, whatever cash that the company was producing was going back into the business, right? But now the company has a lot of cash, so it has slowly started maintaining it as investments as well. Coming to the current assets and current liabilities, the current assets have gone up at a both actually current assets and current liabilities have gone up at higher rates versus revenue, right? I mean 4.5 here and 3.9 times here. So obviously the net figure would have a higher increase. So you could see here that in current assets less current liabilities, the CAGR is 24.2%, right? And versus a revenue of 10.8, the net working capital, so to speak, right? But if we look also at the net working capital here, the CA current assets minus current liabilities, so it was negative in the 3 years, but more than that, it's just going slightly in the positive trend. And these years actually it has slightly increased. So actually from 300 and 400 cr almost here to a quite higher figure in these years. And this is something that we'll have to figure out, that what is the reason for the slight increase. Since the difference is positive, it indicates more or less, right, a huge increase in current assets, and that's something that we'll have to check out. All right, so now we've mostly talked about the financials. Let's look at the growth as well. Now, the important thing to understand here about the growth is, if you look at the current years, right? So if you look at the last 5 years, the median is 11.5, right? And in the last 5 years, the growth has been either at or below median, right? This is something to understand here. Now, so this is something that you could say is one slight cause of concern, that the revenue growth is not as strong, although you could see it's about around 10% in 2 years, one up, one down, right? But in the remaining 3 years, it's slightly weak, right? With EBIT, you could say just with EBIT and PAT as well, you could say that there are a couple of years of weaker performance for EBIT, this one and this one here, right? For PAT, you could say this one and this one here versus two, because these two are the lowest, right? And with EBIT as well, these four actually are the lowest, right, amongst the lowest. So that is something that needs to be understood, that how does the company, how the company comes back on its high growth path, right? Because even if you say a 10% or 12% revenue growth rate, then the EBIT and PAT growth rates could be greater than that, right? So even if the company doesn't need to grow its revenue by 25-30%, but it still needs to get back on track around the, around the 10% mark or slightly greater than that, right? Cash flow from operations is understandable, it's slightly more volatile, right? But I mean, if you compare it versus if you compare it overall versus the profit, then the performance seems good. Equity has been steadily going up, steadily going up. It is compounded very strongly. In fact, the growth in the most recent year was the lowest, probably due to a higher dividend payout or something like that. But apart from that, I mean, just very consistent one-way movement, right? With regards to assets as well, I mean, a large part of it has to do quite a bit with investments, and you can see that it has been growing at a healthy rate in the recent years as well. Current assets less current liabilities, we've already talked about. When we come to specifically to liabilities, right, I mean, this has been slight up and down here, because the non-current liabilities were paid in these couple of years, but the current liabilities, were broadly in following an increasing trend. So that is why the liabilities growth seem inconsistent. But what we care more about when it comes to liabilities is leverage position, which seems to be very comfortable. All right, now let's talk quickly about the metrics. Now these numbers that you'd look at, return on capital and return on equity, would be very interesting, especially to look at the breakdown, right? So here the return on capital was slightly lower because of the borrowings, but after that, these are just sheer amazing numbers, right? It has never fallen below 30%, except for that 1 year, right? And even if you look at return on equity, the minimum return on equity is 27.3%. right? And the minimum return on capital is 18.1%. So the company is producing lots and lots of returns. The company is producing heavy returns, which is why it is able to reinvest into the business. It is able to pay out its shareholders in the form of dividends, and still it is able to maintain investments. So this is what high return on capital and high return on equity does, and it is more or less natural for the FMCG sector to have these sort of figures, right? Because the turnovers are very quick, as we look at here. But the impressive thing that to look about here is, if you understood about the expansion in EBIT and PAT versus the revenue, so this is the reason for that. So the margins have consistently gone up from EBIT margin from 3.7% to all the way up to 14.3%, and PAT margin from 2.9% all the way up to 12%, right? So this is 3.7 to 14.3. It's slightly lesser than almost 4 times, and this is 3% to 12%. So this is slightly more than 4 times. So this is how much the margins have improved. And it is understandable that in the FMCG business, the margins are not very high, right? Because even though the production cost sometimes might not be extremely high, but the companies also spend, heavily on advertising, and distribution is also a very key factor, right? So that is something understandable, that net the margins don't remain extremely high, but still the company has been consistently able to improve its margin, and I think more or less these margins will be maintained in these. So if you look at these years, so the EBIT margin has been maintained, more or less maintained. It's slightly positive trend, but still maintained. And PAT margin has improved, but it will be interesting to see that how these margins go forward. Because if the company is further able to improve its margins, then it will be even better, right? Now, we've talked about the solid performance of margins, but what about the other aspect, which is the turnover ratios? So if you look at the turnover ratios, then in these years, the turnover ratios were just staggering, right? I mean, these are extremely high turnover ratios. The company is able to use its existing capital base so many times, right? So this basically means that the company, from a capital employed of 1 rupees, the company was able to generate almost 10 rupees of revenue, right? So this is the extent of efficient utilization of its capital and resources. Now it's understandable that as the scale increases, these numbers have come down, right? And if you talk about these 4 years, then the numbers are below their median respectively. In fact, in these 5 years, the numbers seem to be below the median. But we have to understand the reason for that as well, especially when it comes to asset turnover, that a large part of assets now are actually not a very large part, but still a significant part of assets are now investments, right? So that is why it will optimally drag the ratio lower. But capital employed has also slightly increased because of the massive increase in equity, right? So equity has gone up by nearly 13.5 times, 13 up to 13.5 times, right? So that is why the capital base is increasing. The liabilities are more or less insignificant, but the equity base is expanding. The asset base is also expanding with lots of investments, right? And this is something, these are interrelated, right? Because the additional equity or the additional earnings that the company has have produced, they have actually been placed as assets, as investments, right? So this is something that you can understand, that why is this falling below. These numbers still look very good, and if we do a breakdown of capital and look at actually the operational capital, then these numbers might look quite better, right? So that is the explanation for that. Assets upon equity, the financial leverage, so to speak, so you could say it was higher in these years, right? But most of the liabilities are actually current liabilities. The non-current liabilities, as we saw, were very insignificant, right? And in the recent years, you can see this as well, with non-current liabilities to equity. In the first year, I mean, in not the first year, but in FY11, there were borrowings which were paid back, and since then it has been, in these years, it has been highly insignificant, right? Let's wrap up with understanding the cash flow positions. As we saw, cash flow versus PAT, it has been very solid. Just 3 years where it's been less than, where the profit has been more than cash flow, right? So that's pretty good. Net cash flow, you'll see very low numbers here, either positive or negative. My understanding here is the fact that whatever cash the company has produced, most of it in the initial years went into reinvesting into the assets, right? And paying out dividends as well. In the more recent 4 to 5 years, my understanding is that the company is reinvesting to the business. It's paying out some dividends consistently. So it is not abruptly increasing its dividend payment, but it's steadily increasing its dividend payments, right? And maintaining the existing cash as investments. So that is that on part of the company. Current assets less current liabilities, you could understand slightly volatile, higher numbers here, so much larger increase in current assets in the recent year. All right, so that is about the metrics. Now let's wrap up with the revenue, with the highlights. Starting with revenue, as you've talked about, massive growth in EBIT and PAT versus the revenue growth, 2.5x for revenue, 9.7 and 10.4x for EBIT and PAT. So lower growth in recent years, at or below median. This is with regards to both. Sorry, actually all three: revenue, EBIT, and PAT. So this will be one point that will be very interesting to see. CFO greater than PAT in 7 out of the last 10 years. Cumulative CFO stands at around 7,408 CR, and cumulative PAT stands at about 6,953 CR, right? So somewhat a 450 CR difference there. CFI, the cash flow from investing, includes investments made and fixed asset reinvestment. So in the initial years, investing into the fixed assets, and in the more recent years, significant investments being purchased, right? Equity is up 13.5x with hardly any increase in the non-current liabilities, just a small debt issue in the recent year. Growth in CA and CL slightly faster compared to growth in revenue. This is something that, again, a point that is something that we can explore further. Non-current assets have increased to 5.2x versus only 2.5x for revenue, but this includes significant long-term investments, as we've discussed. The return ratios are staggering. Return on capital greater than 30% in 9 out of the last 10 years. Return on equity greater than 30% in 8 out of the last 10 years. And even in the years that it was not there, it was 27% and 29%. So, I mean, very, very strong numbers. EBIT and PAT margins have increased consistently, currently at their highest. This is a highlight for me, right? Because this is very difficult to continuously push up margins, right? But the company's been able to do that. Capital and asset turnover have broadly declined, as we discussed, but still they're respectively above 2x and 1.4x, and they might seem optically lower right now because of investments being made, short-term and long-term investments both. Minimal financial leverage, AE below median in recent 5 years, debt raised in FY20 insignificant. The non-current liabilities to equity also very low, insignificant here. All right, so now let's try to conclude with the performance of the company. Sufficient cash generation to grow and pay out its shareholders. So this is very strong on part of the company, and still it's maintaining in its investments to have a base in order to keep the dividend payment smooth, and also to invest more into the capital, or invest more into the business, or probably it might also look at some acquisition opportunities as well if it looks to expand into different areas, right? So that is why it is able to maintain that base as well. So what's the conclusion? My understanding here is that strong financial performance, strong financial position, staggering return on capital numbers, very improving profit margins. Capital turnover slightly declined, but I still think it's pretty solid. The challenge is growth, right? The challenge has been growing the revenue, and even if it gets to a decent low double-digit revenue growth, then it can translate into much better performance, as we've seen. So that would be interesting to see. The thing to watch out for me with respect to this company would be how it grows. So that is all that I had to share about this company, which is Britannia Industries. If you found this analysis, high-level financial analysis, helpful, then please share this video. If you want to discuss anything, then you can drop in the comment box below, and I'll get back to you. If you want to receive this and much more straight to your inbox, then just find the link to sign up below. The Excel sheet, the link to the Excel sheet is also available in the description. Thank you so much for watching. If you found this helpful, then please share it, please subscribe, and let me know if you want me to analyze any company. Thank you so much.